What a time to talk to John Manley of Wells Fargo. John, come on in and let's talk about end of the quarter. What was the biggest surprise for you in this first quarter of 2012?
Well, I suppose how much it went up. I mean, I thought it was going to be a trading range throughout the year. I thought we'd see good moves up from time to time, but the speed of the ascent really got to me.
In this section, let's really look at sort of where we've been, where we are. Let's look at dreaded first chart right away, and this is the Dow. There's into the crisis, out of the 09 bottom, and there's that new leg up. I would suggest a lot of people didn't get on board this leg coming out of the tensions of last autumn.
Well, certainly not at the bottom. I think as it climbed, obviously more people were coming in. You know, as you climb the wall of worry, there's more worry behind you and beneath you. But I think it's still an underinvested market. People are still looking for a place to go. I think, especially among private clients, I really do sense that there's not a great deal of trust in equities longer term.
Longer term, like they've been broken in the 2008 crisis.
Or before that in 2003.
Come on, 3 years of good returns, and they'll come back. Can we say that?
Well, look, they never entirely went, and they're not necessarily the last people to get on board. That's not true at all. But I think people have been left with some sense that earnings can't go much higher, that stocks are inherently volatile, that they need something else. I don't think that's the right viewpoint. I think it's a majority viewpoint, a shrinking majority, but I think there's still minds that can be changed.
401k with an equity skew, is it a double-digit world, or are we still in this new normal of single-digit returns? Say thank you.
Well, you only have to get single-digit returns, very low single-digit returns, to beat risk-free. Now, to actually live, you need to do better than that.
That would be true.
I think you can actually do that maybe at a year or two from now. The market is still very well valued. There's still a compression of multiples because of concerns about earnings. And if those concerns ease much the way they eased back in the mid-'80s, you can see some pretty good markets out there.
I want to look at the Dow now, longer term. We just showed it back to the crisis. Bring me up chart 2, if you would, here, which is the semi-log Dow, much like the Ibbotson chart, and we're really pretty much on 10. Your slope matters, absolutely. Here we are, it's an Ibbotson chart essentially from the Depression. You can see the percentage change in the Depression, nowhere near that carnage now, and we're sort of back to trend.
Yeah.
Are we spoiled when we look back 5 years, 10 years? Were we asking for too much?
Oh, I think we were. We always ask for too much. That's our nature, to ask for too much. If we didn't ask for too much, we wouldn't get anything sometimes, I think. But I do think you have to look over a long period of time, very long period of time. A mid-high single-digit return is still a pretty good return.
I want to come back and talk about one of your great themes. Here's from your note. Let's tease it a little bit here. This is great. Corporate managers are pressured to produce results that benefit shareholders, and to succeed, they must be responsive to the needs of those shareholders. Are managements different this time around? If they fundamentally changed?
Different from 4 or 5 years ago? No. Different from 25 or 30 years ago? Yes. I think managers have to be more sensitive to what's going on around them. The stocks just didn't go up because the stocks went up. You had to induce people to buy them. Okay,
I want to do a question of the week right now. Let's look at it if we can here. Midday at Bloomberg.net is how you can get into next week's question. Japan saw a housing collapse similar to ours, and home prices fell for more than 20 years. That chronic, that persistent land price decline. How is our situation in housing different from Japan, or for that matter, different from Spain?
Well, I think one thing, we didn't have quite the same ascent they had. I mean, it was crazy here, but it was utterly crazy over there. So, number one, it wasn't as big of a boom. Number two, Americans are better at being wrong than the Japanese. One of the things we're particularly good at in America is being wrong, finding out we're wrong, and moving to fix the situation more quickly. So I think we won't have that kind of hangover that they had. 20 years is a function of almost ignoring the problem, pretending it didn't exist, being too polite about it. And you can't accuse us of being too polite.
Why can't we clear the housing market like we've been famous at clearing other markets?
There's a lot of sensitivities and sensibilities involved. I mean, it's a political hot potato. I think it will clear. I'd almost hope we do something like the TARP program for it. But I think, at some point in time, it will clear. It's a matter of time. It's not as long as the Japanese. It's not as short a period as I'd like it to be. Right. But it's in the process of doing it right now.
One of the hallmarks this quarter was a major firm that issued debt below LIBOR, which I had never seen. This is going to be a big thing. We're going to devote April 9th show to it. This idea of buybacks. Has it gone too far?
No, I don't think so. I mean, are the corporations too leveraged? If anything, I think they're under leveraged at this point in time. Cost of debt is still very, very low. You make things inexpensive, you expect people to buy, to do more of them. So I'm not surprised at all it's happening this way.
The cynics would say they're buying in their equity at the top of the market. You don't agree with that. You see, I would say you're constructively bullish.
It may be the top for a month or two, and it may be the top for 3 or 4 quarters. I have no idea, but they're not buying it back at extremely high prices or extremely high valuations.
How do you value the market right now?
Well, I just look at earnings. I mean, I can just look at earnings right now and say it's around 13 times, which in a vacuum is sort of the very low end of normal. Against risk-free rates, it's actually quite attractive, I think.
I want to look at this chart because to me this was one of the moments of the quarter. And this is Comcast, too much information, and to the Roberts family where they finally deploy cash. Here's the dog decade for Comcast. And finally, we get shareholder yield with that announcement they made a month or so ago. Boy, look at the stock return there. Is that the new mantra for corporations?
You got to make the people happy. If you want people to buy your stock, you have to give them something. It's harder and harder to find growth. It's harder to have organic growth. So what do people need? Corporations have a lot of cash. People need money to live on. Institutions need money.
I love how you say that. Let's rip up the script right now. You've got organic revenue growth. GE used to live by it, which you should work off nominal GDP. In a new normal, nominal, what is your nominal GDP number? And then how do you work organic revenue growth off that for major companies?
Well, it depends where you're looking, but if you look in the U.S., it's probably somewhere in mid-single digits. I mean, it's
5.
Yeah, 5, 6.
Okay, I'll go with that.
Okay.
That's organic, or is that nominal GDP?
That's nominal GDP. Corporations are exposed to faster growing parts of the world, so in theory they can bring in a little bit
200 basis points on top.
That's a fair number.
It's a 7% world. Should our viewers invest assuming a nominal gross return of 7%? You're killing me if you say yes.
I don't think you can get more. Valuations can change. We're at low valuations right now. Valuations can expand for a while. You can also invest in different things. If the world grows at that, you don't have to buy a corporation that grows at that. Some corporations can grow more. But, when the risk-free rate is 100 basis points out about 5 years or so, if you get 7%, the island of Manhattan has only appreciated about a 6.2% annual rate if you use the $24 number that I learned in school.
Right.
So, I mean, over a long period of time, 7 isn't terrible.
We're back or almost back to the 30s. Let's look at this wonderful op-ed. Whatever your politics and economics, check out DeLong. He is one of our great economic historians, even if you disagree with his, I'm going to call it more left economics. In the U.S., we can already see signs that the downturn that started in 08, it's casting its shadow on the future. Reputable forecasters have been revising down their estimates of potential long-run GDP. Maybe that's like a Bill Gross, L-Arian new normal. Do you fold that into your work, or do you say, forget about it, we're going to return to a normal America?
Whatever will be the normal. So looking back and saying the old normal is going to be the new normal isn't necessarily the case. I think there's a lot of potential for growth that really isn't being looked at. I mean, you do have what they used to call the developing world, what they call the third world, what's the emerging markets. As long as everyone on Earth doesn't have everything they want, that's a great potential for growth. And the trick is to try and structure it so that growth can be made manifest, so we can sort of match up buyers and sellers in that environment. So, yeah, maybe in the U.S. it's not going to grow.
Is it simple for a retail customer, a private wealth customer? Is it simple for them to just say, what portion of my portfolio's revenues are from abroad if they own American companies?
Well, they can find that out. I mean, these numbers are published numbers.
We hope they use a Bloomberg to find it out. But
where else would they go? And, right. But the basic, you can find out where it comes from. You can find where your profit is coming from. You can find where the growth is coming from. So, I would advise individuals to do that, because some of the areas we like specifically because they have exposure to what may be an emerging middle class in a lot of these emerging markets.
Let's spin forward to the second quarter. Chart of the quarter. There were a couple nominees for this. I just picked this up because we've used it so much. This is that central bank debt expansion on their balance sheets. The yellow line, the Fed, the white line, Draghi comes in. Look at that leg up in the ECB over the past 3, 4, 5 months. Do you presume a smooth exit by the G4 banks to bring their balance sheets down so that you can stay invested confidently?
I think they can make it smooth enough so it won't be worth my while to try and time.
To try to game it.
You know, it's not going to be perfectly smooth. It's almost impossible to be perfectly smooth. On the other hand, I've always figured the heads of central banks are at least as smart as I am. And if I see these issues, they see them too. They know what they're getting into. They know why they're getting into. They have a pretty good idea of what has to happen before they get out of it. And I think in Mr. Bernanke's case, if anything, I think he sort of made the decision that if he's going to be wrong, he keeps rates too low for too long than the other way around.
Late March, new vogue phrase, like green shoots, except it's fiscal cliff. Do you worry about the fiscal cliff late this year and into next year?
It's going to have an impact. I mean, if the Bush tax cuts are not extended, it will have a measurable effect on GDP.
But even separate from those tax cuts, just the uncertainty.
The uncertainty is always with us, and I think there are headwinds going into next year, and it is going to be slower. And again, when you look at what we like, a lot of it's non-cyclical, and the cyclical stuff is growth cyclical, we think.
John Manley, thank you so much.